Going to finish chapter 1, and we're going to pick up where we left off on the financial statements. But just to review, had some people in the office hours a little bit before we started class, and what we did so far is we walked through this accounting equation, and of course you have to be sure that everything balances. The next step is to think about the accounting equation. So far we think about it as the basis for recording, and we will also use it as the sort of the document that would become the basis for building the financial statements. Now, the last couple of slides I do every day, I'm going to try to cover them again. So let's go back and we'll pick up with the income statement about preparing the financial statements. So where we left off, and this is the last learning objective of this chapter, we are now looking at the financial statements. So the financial statements, let me go back a little bit if I could. The financial statements would include the income statement, the statement of retained earnings, and the balance sheet and the statement of cash flows. Now, a lot of you are getting ahead, which is great. You're doing a lot of the assignments. Some of you came up to me with cash flow questions. That's great. But let's start again from the beginning. This is the order in which the statements would have to be prepared. Each statement, if you started doing some of the homework or if you did read ahead, you're going to notice that the statements will articulate, which means they feed into each other. So you need to have income to do the retained earnings statement. You need to have the retained earnings statement in order to do the balance sheet, and you need the first three statements in order to do the statement of cash flows. So the statements have to be prepared in that order. So we said the income statement is going to report the success of the business, the revenue, or the income or the loss for the period. And as I said, the income statement will just list revenues, expenses, gains and losses, and net income or net loss over a period of time. As you notice on the accounting equation, the revenues, expenses, gains and losses, or the income will flow right into the retained earnings, and it does increase your wealth. So there are a couple of ways to increase your wealth: through revenues, through gains. Expenses decrease wealth, losses will decrease wealth. That is reflected on the income statement. Now, the model of the income statement, as I said, if you look at it, linearly here, it's simply revenues or gains, and these are inflows of assets or they reduce liabilities. Expenses or losses are outflows of assets. You use up assets or they increase obligations. So just to clarify this, you could have revenues by selling it for cash. That's an asset inflow. What's the other side of a revenue transaction? If it's not cash, what other asset could you get? Anyone? Accounts receivable or receivable. So any asset inflow. Now, we went through this already. You could also reduce liabilities. What kind of liabilities do you reduce? Advanced collections, unearned revenues. As I mentioned, if someone pays you in advance, it's a liability. When you satisfy that liability, so for example, we talked about sport franchises where you buy season tickets to baseball or football games. When you pay for that, the person collecting it has a liability. That liability is paid off when they play the games or when they deliver the online periodical. So literally, this is the definition. You either increase an asset with a gain or revenue or reduce a liability. Now, we'll see more of that as we move along. So the question is, preparing these financial statements today is going to be coming from the accounting equation. So in this case, when we look at the accounting equation, the only revenues we have would be the service revenue, the rent expense, and the salary expense. So we know that the net income for the period is $5,300, and as I said on Tuesday, there is a dividend as well, but that dividend is not an expense. Dividends reduce retained earnings, but they are not expenses. So now we're going to use the $8,500 in revenues and the rent expense of $2,000 and a salary expense of $1,002 to prepare the first statement or the income statement. So let's do that now. So if you go to the next slide, it'll show you what the income statement looks like. The income statement, again, lists revenues and expenses, gains and losses, and the net income or net loss for the period. A couple of things to notice here. We left off with this. Again, you have to have the name of the company. I mean, you know, some of these strict rules you have to follow. The title of the statement, and it's for the month ended. It's a flow statement. It's for 1 month and 1 month only. It's the change in revenues, the change in expenses over that 1 month. So here's the format, and a lot of you have been working on this, and you see the format is already built into the homework module. So when you do the homework assignment, it's there. So you have to start with revenues, and then you list the expenses. The last thing I said on Tuesday was that we generally list expenses in the order of magnitude, by size order, but that's not always the case, because when I said also that at times it's important to highlight certain key expenses for the enterprise. So for Johnson & Johnson, we know that their most important expenditures are on research and development and on advertising. So those expenses would be first. Even if they weren't their largest, the stockholders of Johnson & Johnson want to know how much money they're spending on research. It's an extremely important expenditure for that type of company, and that's why it may be listed first. Now for us, as far as the homework is concerned, you're probably going to list that as, or in the order of magnitude. You're probably going to list it in size order rather than in the order of importance, because you wouldn't know that from some of the problems we're doing. All right, so that's where we left off. Before we start today's material, any questions on the income statement? That was the last thing we looked at. You have a question? Okay. All right. Then your next statement is this statement of retained earnings. And the statement of retained earnings will show you how retained earnings went from the beginning to the end of the period, how it changed from the beginning of the period to the end of the period. And there's only 3 ways that that could change: revenues, expenses, well, revenues gains, expenses losses, and of course dividends. And again, dividends are not expenses. So when you look at the statement of retained earnings, you're going to find that it will have, again, the title of the company, the title of the statement, rather, name of the company, and for the month ended. Now this example assumed that retained earnings started with a 0 balance at the beginning of the month. Net income for the month comes from where? Where'd you get that number from? The income statement. So this is the idea of articulation. You had to prepare the income statement first. It feeds into the statement of retained earnings, and then of course the dividends are paid. And again, the source of the dividends is going to be coming from the accounting equation. So the change in retained earnings for the year, you started off with a 0 balance. You had revenues and expenses that gave you net income of $5,300. You paid out dividends, and the change in retained earnings was $300. Now you can see it readily here, but these right now are your bookkeeping, or is your bookkeeping device. These are your accounting records, but the accounting records, that kind of detail is not very useful. So we were talking today in office hours, and I said, well, let's say you wanted to borrow money. Having all that detail in the accounting equation, you just can't hand this to a banker or to a loan officer at a bank. It doesn't give you any information, or it does, but it's very difficult for that person to strip out what they need. So we believe that the financial statements provide that information. It communicates the results of operations, as we did in the income statement, and now it communicates the change in retained earnings. So the change in retained earnings, a relatively simple statement, and again, it simply goes from beginning retained earnings, net income or loss, minus the dividends to get you to the ending balance. So the ending balance in this case is $300, beginning balance was 0. What accounted for the change? The income minus the dividends, net income minus the dividends. And again, let's go back to that statement. So you started with no retained earnings because you just started your business. You earned $5,300 in income. You took $5,000 out of the business as a dividend, and the $300 is your ending balance. So you start next month with the 300 beginning balance of retained earnings. And one of the things you'll find out is that the ending balance of one period becomes the beginning balance of the other for balance sheet accounts. Income and expense only survive one period, obviously. If I want to know how much you made last month, it's only for 1 month. But if you have money in the bank and you end last month with $1,000 in the bank, you start this month with 1,000. Okay? All right, so any questions on that? Any questions on the statement of retained earnings? This one is fairly reasonable. Okay. Now, our next statement is the balance sheet. And again, the statements articulate as we said. The next statement is the balance sheet. And as we said earlier, the reason why we do these in order for the balance sheet to balance, you need retained earnings. So you have to have the statement of retained earnings prepared first. And the balance sheet is going to report assets and claims to assets, as we said, at a point in time. The difference, by the way, between the first two statements, the income statement is a flow. It's, if you look at very old accounting textbooks, they talk about the income statement and the statement of retained earnings almost like a motion picture. It's moving. It's the activity for a period. The balance sheet is a position. So it stops them. It's like a photograph. It snaps the picture and says, what do you have at this point? So it shows you the assets and the claims. The claims, of course, are the liabilities as well as the equity or the owner's claim to those assets. So the balance sheet is a listing of those assets, liabilities, and capital or equity at a point in time. It is a stock of wealth. It has, various sub-accounts, as we'll see in a few minutes. That cash, of course, is an asset account. Accounts receivable is an asset account. Accounts payable is a liability account. We have various accounts in the balance sheet. The balance sheet also presents, as we said, cumulative balances. These balances, as I said, will carry over period after period. They are incomplete cycles in a way because whatever is on the balance sheet will have implications for the next period. For example, if you had sales in the month of November, those sales are finished. They don't affect December sales. But if you have a cash balance in November, that cash balance carries into December. Or if you have a receivable in November, that cycle continues in the next month. You still have to collect that receivable. If you have a payable, a liability, that payable carries into the next month. The other important point that I'll show you in a minute is that the way we list the assets, we list them in what is known as the order of liquidity. Liquidity is the ability to convert an asset into cash with minimal risk of loss. Now, cash, of course, is the most liquid. That comes first. And we were actually talking about this during office hours. We had, we gave an example, or I went through an example with the group of students that were there, and they said, well, all right, you got cash, you got receivables, and you have inventory. And I said the most liquid is cash, the next most would be receivables, and then inventory. And someone said, well, I thought it would be easier to sell inventory than receivables. Well, that really depends. Typically, you could sell receivables pretty quickly. Inventory, it may be obsolete. What if you bought, this computer and you had it in inventory, and the longer you hold it, the less likely is you had to liquidate it. If you had to sell it in a distressed sale, the less likely it is you're going to get full value or what you paid for it. So it really will depend, but typically liquidity is cash, receivables, prepaid expenses, as we'll see. Liabilities we list in the order of maturity. So the current assets go first. So something like accounts payable will come before a mortgage. Whatever you have to pay faster comes first. So if you have a credit card bill, that's current. If you have a auto loan, that's not current. So the current liability will always come first. Yes, question, Jeffrey? Yeah. What does not go to the next period? Yeah, what types of accounts do not carry over? Revenues and expenses and dividends. Those will only last one period. So the income statement accounts only survive one accounting period. Okay? Yep. Balance sheet accounts will carry over period after period. All right. And we'll see that more and more as we start doing more examples. All right, so then again, getting back to liabilities, you've got the current obligations first. That's what you have to pay off first. And then liabilities that are long-term, like auto loans or mortgages, would come second. And as we go through the course, you'll understand why we do that. I think it's clear that the reader wants to know what liabilities do you have to pay right away, and what are you going to wait to pay. So it'll give you an idea of when your cash has to be dispersed. And, we do that ourselves, right? I mean, if we have payments that are due quickly, we worry about them, or we put them in the forefront of our mind faster than if we have to wait. And, of course, contributed capital on the balance sheet will come before, that's common stock. Contributed capital comes before retained earnings. Now, contributed capital, just a side note, because I know a lot of you probably use Twitter. Twitter is trying to go public. They don't have stock out there right now, but they may actually sell stock like Facebook sold stock, and that means that they're going to start going public, and they'll have a contributed capital account for the common stock that they sell. So that may happen in the near future. Okay, so now let's look at the balance sheet. And I'm going to get back to these numbers in a second. But once again, you've got the name of the company, the title, and notice the balance sheet date does not say for the month ended. It just says at November. So a little, a minor point, but significant. The balance sheet is a snapshot at the point that you're looking at it. The income statement is for the period. It's a moving entity or a moving statement. So where do we get these numbers from? The numbers come again, right now, all we have is the accounting equation. So all we have right now is going to be the accounting equation. So when we look at this, we would take the balance sheet from here. We've got cash of 9. You've got accounts receivable of 1,000, office supplies of 5, and land of 20. Those are your assets. Your liabilities are 200 in the accounts payable. And then, of course, we already know that from the statement of stockholders' equity that you'd have contributed capital of 30 and ending retained earnings of 300. So everything comes off this bottom line. So if you're building the balance sheet, you're going to build the balance sheet from the bottom line of the accounting equation for that month. So the assets are very easy, liabilities are easy, contributed capital is right there, but where do you get the retained earnings? Well, as I said, it's got to come from what? The statement of retained earnings. So you need that statement first. Yeah, I'm sorry. I'll repeat the question. Yep.
2 questions. Can you do a balance sheet in the middle of the month?
You could you do a balance sheet at the middle of the month? Yep, you could. Probably, it depends on the company. So companies have discrete periods where they split their accounting reports. But if you needed something on the 15th of the month, you could do it. So.
Yeah, and what's the difference between this and the income statement? Are they the same?
What difference between what, the balance sheet? No, big difference between the two. The income statement is showing you the change in wealth from operations. The balance sheet is showing you the total position, which includes all of your assets, liabilities, and capital. So the income statement, the question is, what's the difference, balance sheet, income statement? The income statement is only showing you how your wealth changed through operations, then minus dividends. But the balance sheet is that total. It's that snapshot of what you have. What assets do you have, and what liabilities do you owe, and what's your capital? What's your residual equity? All right, so now going back to the balance sheet. Again, let's look at the assets. Let me get the pointer up here. Okay, so if you look at the assets now, we list them in the order of liquidity and how fast can you get cash. That's what it means. Liquidity means how quick could you get it with minimal risk of loss. So you could get cash, of course. You've got it. Go right to the bank. Accounts receivable, you could sell them. A lot of people buy accounts receivable. There are businesses that buy them. Office supplies might be more difficult to sell. Land takes a long time, right? You got to go to a lawyer and get contracts. So you can get cash much more quickly with, of course, receivables than you could from land. Total assets, of course, at $30,005, which was the total on the bottom of the equation. Accounts payable was given, and then, of course, here, you got your common stock of 30. That was your original investment by the stockholders. And then, again, where did this come from? That came from the statement of retained earnings. You don't find that 300. Let me go back again and remind you that you do not find the 300 anywhere on this accounting equation. That 300 had to be determined, or you had to develop that number through the statement of retained earnings. All right, so those are, so far, the primary financial statements. The fourth is cash flow, which we'll get to. Yes? Okay, so the question is, if the company has cash, why wouldn't they pay off the liability? They will, but they might wait until the end of the month when it's due. Maybe the payable was in the middle of the month. So, for example, if you your credit card cycle is at the end of the month, no, it's like the 15th or something. Yeah, so you get your your credit card bill comes in, you got a month to pay it. You probably will wait until the end of the month to pay it, or the end of the billing period to pay it. Right?
The income statement has the revenues and the expenses, but what about the other page that you were just showing us with all the transactions?
The equation. Okay, let's go back. So, sorry about that. Okay. So if we wanted to, the income statement shows the revenues and expenses. So yeah, the income statement is showing you the summary or the total of the revenues and expenses. This is simply the accounting equation. So that's the device. Okay, so again, today during office hours we were talking about the applications. So probably not everyone here wants to do accounting for a living, so I understand that. But if you wanted to be into computers or information technology, if you were building an information system for your client, you would have to build a system that accumulates transactions, summarizes transactions, and then reports them. So this would be the place where the transactions are accumulated.
So this is just an accounting equation, it's not the income statement?
That's right. It's simply the device that you would use. If you were a systems analyst, you would have your client accumulate their transactions in this accounting equation. Now, in a few minutes, we're going to show you better ways to do this, because this is kind of cumbersome. I mean, if you took a business like, Apple Computer, your accounting equation would probably be about, 700 pages long, and it would make no sense. But for a small example like this becomes the place where if you were building an information system through a company's computer system or reporting system, you would accumulate the transactions in the equation. So this is not, to make this very simple, this is not a financial statement. This is not the financial statement. This is the device that you use to accumulate transactions. Yeah, Jeff? Right. Every month. Well, let's just assume this company is this size and you had no other option but to use the accounting equation. Yeah, you would just keep building on top of this. So we're going to find out, as I said in chapter 2, that we'll have a much more efficient way to accumulate business transactions.
Is that on Excel?
I'm sorry?
Is this done on Excel?
Excel, yeah, you can do this. Yeah, if you wanted, you could build this on Excel. You could build all accounting information systems through a spreadsheet system. Yeah. Is that Tom?
Yeah.
Tom, okay.
That we have to say it's as accurate as possible, because you're not really getting a true perspective of the cash on November 30th exactly, because you're not receiving all the reports exactly on that date.
Right. Things, right. So things, yeah. I mean, these are as of a certain date or a certain time in which you would report, but it would be accurate. So let me tell you why. So the question is, would this be an accurate measure of the cash you have on November 30th? Well, you don't actually prepare these on November 30th. You could be preparing these out into December. So when you do accounting or you build an information system, you work with the client days and months sometimes after the end of the period. So if a business has a December 31st year end, the accountants and the systems analysts are building the statements out into February. So you know what the ending cash balance was as of that date. So you do get, you do have a lot of estimates, but that is as accurate as you're going to get it. Okay. All right, any other questions on the balance sheet? But again, to be very clear, one more time, the equation is the device we use for recording transactions. These are not the financial statements. The financial statements use the recording device to summarize the data and make it more useful. I mean, obviously, looking at this is not very useful, but a balance sheet, income statement, and cash flow statement, which we'll see, does have a lot more use. And that last statement is the statement of cash flows. And this is another flow statement. And this one's difficult. We're going to come back to this, I'm sure, at some point. The cash flow statement we're doing here is really just an introduction. It's going to show you the sources and uses of cash. Where do we get the cash, and how is the cash used? Now, when you look at the reason why we have the statement, again, it helps the reader understand where the company gets its cash and how it's spending its cash. So it's its source and use of cash. And it's also useful to determine whether or not the company has enough cash to pay off its obligations when due. Now, the biggest problem for us is understanding how the cash flow statement is organized. And it's organized by cycle or activity. And there are three primary activities: operating, investing, and financing activities. So and in some cases, it's probably more important to know the source or the activity that creates or uses the cash rather than the amount. And you'll see what that means in a moment. But if you look at operating cash flow, these are the cash flows that you're generating from your day-to-day business operation. It's your cash from revenues, expenses, gains, and losses. So this is the cash that you're getting from your day-to-day business. Investing cash flows would be involved with buying assets and selling them, like plant assets, equipment. That is not part of your normal business. And if you remember, we talked about the difference between Dell Computer selling computers, which would be an operating activity, or selling off a building, which would be part of its investing activity. And the other activity is going to be financing. Financing activities are involved with borrowing money, paying off debt. This is long-term debt. Issuing common stock and paying dividends. Those are known as financing cash flows. And again, it's much more important to know the source of those cash flows than, in fact, the amount. And what I mean by that is, if you think a little bit about the activities, what cash flows, if you were looking at a company and you wanted to determine whether or not to provide financing, to lend money to that company, or if you wanted to invest in a company, what cash flows to you would be of the highest quality? The cash coming from operations, the cash coming from selling off a building, or the cash coming from borrowing? Anthony? Yeah. Operations, right. So the operating cash flow is going to be the higher quality cash flow than, let's say, investing or financing. Now, the other thing that's important for us, and I had two questions on this already right before class, so it's something we need to spend some time on, and that's the idea of reconciling the beginning and the ending cash flow. So what you'll find in the statement of cash flows is that it'll be organized as follows. You'll have cash. You'll have cash coming from operating activities, investing, and financing. The total, when you add those up, that becomes the change in cash. So basically, that's going to be your, when you say the change, that's either your increase or decrease. When you add the beginning balance it gives you the ending cash balance. So on one of the assignments, a couple of people came up before class, and they said, well, how do I get, this number, the change? The change is the sum of operating, investing, and financing cash flows. That's the change. And that change is added to the beginning balance to get the ending cash flow on the balance sheet. Now, we're going to do, finish this example. And again, it's kind of, cumbersome to use the equation, but we will do that. All right, so that's the reconciliation that the textbook talks about, that at the end of the period, you have to show the reader the change in cash flow added to the beginning balance. It gives you the ending balance of cash. All right, so now let's take a look. Unless there are any questions here, is everyone clear that that's what they're looking for in some of those problems? Okay. All right, so let's go back to counting equation. And you have to remember, it's the beginning of the period, the beginning of the period started the business. So there's no cash to start, so your ending cash has to be 9. You have no cash to start, the ending cash is 9. One of the good things about the statement of cash flows is that you always know the answer. If you take beginning minus ending cash, you know the change. Change got to be 9 in this case. Problem is when you don't get that answer. But you know what it has to be. So the ending balance of cash, you started with nothing because you had the original investment in the business, and you have $9,000 as your ending cash balance. Now, let's see if we can pull this together by looking at the statement and keep going back to this equation. So if you look at the statement of cash flows, again, same story. It's the name of the company, the heading. Notice this is also a flow statement. It's a moving picture for the year, for the month ended, rather, November 30th. Now, where do you get the numbers? I mean, you have to obviously work with the equation, and it is going to be a bit cumbersome. They're telling me that you collected $7,500 from customers. Now, where are the transactions that generated this cash? Well, the only place you're going to find it is on the document camera. And first of all, we know that in transaction 4, they sold or provided services for $5,500. So that's $5,500 of the cash. Where did the other $2,000 of that cash come from? They collected accounts receivable, correct. So what happens is that even though you had an additional sale of $3,000, you only collected $2,000 of that. So transaction 4, and I want you to go back and look at this in the slides. Hopefully you have the textbook because it's in there also. But when you want to prepare the cash flow statement and understand it, use this example. Because the cash comes in on the sale of $5,500, that's transaction 4, and then they collect $2,000 in transaction 8. That $5,500 and the $2,000 is what gives you, and I'm going to go back to the statement, it gives you the $7,500 in cash from customers. So the cash from customers is made up of the $5,500 cash sale plus the $2,000 you collected on the receivable. Questions? Yeah. Sir. Could. Yep. We'll talk about that, though. Yep. A test question. We'll get there. All right. Any questions on the $7,500? All right. Now, the other two, the next two are pretty easy because these are cash expenses. So I'm going to give you the references. I want you to go back and make sure you look at them. The references are in transaction number 6, you paid $2,000 for rent and $1,200 for salaries. And that's where you got the cash outflow for cash paid for rent, cash paid for salaries. Okay, so that is transaction number 6. So it's cash paid for rent, cash paid for salaries. So if we go back to the statement itself, those are the next two cash flows. So you pay $2,000 for rent, $2,000 for salaries. The next one is not quite so simple. It's the office supplies. And in this one, you'll find that the company bought office supplies on account. So let's go back and take a look at that. Up here in transaction 3, the company purchased office supplies on accounts payable. Now you notice that didn't use up any cash, correct? So if you look at transaction 3, the company had accounts payable and office supplies, no cash was used. However, back here in transaction, or down here in transaction 7, the company paid off $300 of that payable. So from our standpoint, they used $300 to pay off the office supplies. So when you build a cash flow statement, it's cash expenses, $2,000 for rent, $1,200 for the salaries, and the payment of the accounts payable, the $300, is going to be your cash outflow for office supplies. So again, if we go back to that statement, you've got the $300 for office supplies, and the cash provided by operating activities is $4,000. So take a look at the operating activity section right now. Cash collected from customers is $7,500. Cash paid for rent, salaries, and office supplies totaled $35,000. So you generated $4,000 in cash flow. Now, we're going a little bit ahead. What we're really saying here is that using our accounting system, we reported $5,300 in net income, but that net income only generated cash of $4,000. Is that bad? Well, not necessarily, but that's something you might want to think about. What's the difference? Well, they didn't pay off all their liabilities, but the other more important thing is they didn't collect all their receivables. And that's why you still have some receivables out there, and that's why your cash does not match your income. So income and cash flow may not be the same, and they aren't in this case. All right, so any questions on operating cash flow? Sure. Well, you could call, the question is where does profit come in? Sometimes you got net income, net loss, could be profit. You could call it profit also. This could be the statement of profit and loss. There are multiple terms for income. It could be net earnings, it could be net income, it could be profit. Yep, I'll repeat that question. Yep.
For the accounts receivable back on that sheet, like I understand why there's a minus 300 on both sides, but if it's opposite, shouldn't one side be plus and one side be minus?
No, because what's happening is that the equation still balances. The only time there has to be an equal and opposite effect is if it's on the same side of the equation. Yeah, same side. So the question is equal but opposite effect on the same side of the equation. All right. All right, now, last is going to be the investing and financing activities, and this should be pretty easy. So the only investing activities you have is you invested in land, and that land is $20,000. So that's transaction 2. So when you go back to review this, the only investment you made in plant and equipment or land is $20,000, and the only financing you have would be the common stock of $30,000, which is transaction 1, and dividends are considered financing activities, and that's transaction 9. So once again, let me repeat this. Your investing activities consist only of acquisition of land, which is transaction 2, the financing, transaction 1 for stock that was issued, and transaction 9, which would be dividends. So going back to the statement itself, you have your acquisition of land as your investing activity and cash flows from financing. You got common stock that you issued, and your dividends are paid. So now when you look at this, and here's the question I guess we had earlier, your question was, how do I get the net change in cash, which is 9,000, which I knew my answer from the beginning. It's going to be the sum of the operating activities of 4, the investing activities of using up cash of 20, and of course the financing activities providing 25,000. And the total change in cash is 9. And of course, since there was no cash, you started your business in November, that's going to be the ending cash flow. So the statements, as we say, articulate, they tie together. They all feed in so that income from the income statement goes to retained earnings. The retained earnings balance goes to the balance sheet. And now, where would you find this cash balance, by the way? This is the last sort of link or the loop. On the balance sheet. Right, so this cash is also found back on the balance sheet. So all of the statements will tie together. All of the statements tie together, and that is known as articulation. And that's what I mentioned in the last couple of slides here, that articulation is the ability to tie these statements together, that the statements are related, that income and revenues, expenses affect assets, liabilities, and equity, and vice versa. Okay. All right, now, that is it for this module, and actually going to be it for the chapter. I'm going to ask you some questions in a second. But anyone with any questions now, I know a lot of you have started to try this. It's good to try it in advance. It's always good to be prepared before we get here. All right, so let me ask some questions. Okay, I'm going to get to some good ones. Let me start here. I'm not going to ask you this question. Hold it down. You can talk when the clock goes on. That means you can talk. All right. So now I just want to tell you that in this case. Oh, I'm sorry. Sure. Hold it down. I'm sorry. That's right. The cash was okay. The cash, the 9,000. Yes, the cash. It's the cash from. You want to go back? Hold on. Let me just get this question.
It's the question of how did you get that 75?
Oh, I'm sorry. Oh, yeah. Okay, let me get to that. That number? Okay. Question again. The 7,500. Where does it come from? There was a cash sale of 5,500. There was a collection, 2,000 on the receivable, and that's the 75.
So
9,000 is your ending balance of cash, and if you go, let me go backwards a little bit. That 9,000 is also back on the balance sheet. So what you're doing with the cash flow statement is you're proving how this number was determined. So the cash flow statement basically explains the cash and how the cash changed. Done? Okay. All right, any other questions before we get to some of our questions? Okay. All right, so what I wanted to say, let me get this moving here. Come on, man. There we go. Okay, so in this one, I'm not going to ask this question. A couple of other better questions to ask. Just want to let you know the answers here. Just to remind you, the question is asking you whether or not the income statement and balance sheet are both flow statements. And the answer to that is false. Which one of these is a flow statement? Anybody? Income. Income is the flow. Balance sheet is the static or position statement. So that answer is false because the balance sheet is a static or a position statement. Okay. And the only, by the way, the next one, this is I think way too easy, but answer is A. The only financial statement there is cash flow. There's no statement of return on assets or dividends or anything like that. All right. Now the rest of these, I'm going to move ahead. Sorry. Okay. Now, what I want to do is focus on, if you go to the statements. All right, so here's what I'm going to do. I want to make sure that you understand the statement of cash flows. The other questions are pretty straightforward. They ask you the order of preparation. That's not a big deal. All right, so here's what I want to know. Which of the following are operating activities? So which of the following is an operating activity? All right, so is it cash received from selling off old equipment, purchase of new machinery, office rent, or cash received from the issuance of new shares? All right, everyone should have a clicker by now. If anything happens, when you go on Blackboard, check your clicker grade. If there's anything that's not what you think isn't right, just send me an email with your clicker number. But anyway, okay.
Can you repeat what you just said?
I said if your grades look like what you did, it could be that your clicker's not registered correctly. And I'll check it for you. But I need your clicker number. Okay. All right. So, question is, which one of these is an operating activity? All right, so, 11% say it's A, 23% say B, 53% say C, and then 13% say D. Who has C? You want to get someone? Anyone back there has C? Okay, why? Okay, he did A? Okay, why'd you pick A? Oh, okay. Okay, it's out of time gets you no points. All right, what do you got? Anybody else? Right. So yeah, he's saying that C is the correct answer, and he's right. So it is C. Okay. Right. See. So you're right. Now, rent is needed to operate the business. What kind of activity? Someone help me with this. And this gets you some points too. Somewhere along the way. What is A? What kind of activity is A? Anybody? Right. It's investing. What kind of activity is B? It's investing. So A and B are investing, and D is what? Financing. Okay. So A and B are investing, C is operating, and D is a financing cash flow. Okay. Now these hopefully get a little easier. Okay. Hold on one second. Let's do the next one. Which one of these is an investing activity? Now, based on the first one, nobody should get this wrong. Okay, so which one of these is an investing activity on the statement of cash flows? Depreciation, cash paid for new machinery, cash paid for salaries, cash received from the issuance of shares. Okay. All right, see? Still people are getting it wrong. Nobody should get this one wrong. So, all right, so again, yeah, that's it's pretty clear. Purchase of new machinery is investing. A, depreciation expense is part of operations. Cash paid for salaries is operations. And from issuing shares, it's what? Financing. financing. Okay. All right. Last but not least, and then we'll move into chapter 2. What's financing? Okay. So let's start the clock here. What is a financing cash flow? And by the way, this ties right back to the example we did in class. All you got to do is stay awake with one eye and you'd have it. Just one eye, that's all you need. Okay. All right. Still can't. Yep. I mean, you still can't get everybody, right? So, all right. So the answer, the financing activity, is the dividend. All right. It's the dividend. So, got almost everybody in there. Land is what? Investing, rent, and office supplies. So, A, you buy land, you're investing. Rent and office supplies, same thing as our example, is operating, and cash paid for dividends, of course, is the only financing cash flow. All right, so that takes us through chapter 1. We're not going to do the next learning objective, and we're going to move to chapter 2. So again, make sure that you cover this carefully. Any questions with the homework? I mean, people have been emailing, people have been stopping up to office hours, it's fine. So make sure you do that. Okay. Okay. All right, so we're going to be looking at, we're going to start to look at chapter 2. And in chapter 2, we're going to now modify things a little bit. One of the things we said when we were looking at the accounting equation was the cumbersome nature of that equation to record multiple transactions. So you had questions about what happens if it's another month. Well, you could have another 30 transactions, and by the time you get done for the year, you're getting 30 transactions every month or more. So it becomes very cumbersome. So we're going to be recording in what we call accounts. This is not working. Sorry about that. Oops. So we're going to look at business accounts. We'll look at the chart of accounts here. This learning objective is quick. I'm not even going to be looking at any of the questions here. So we're going to look at the notion of an account, what an account is, and how it relates to the accounting equation. By the way, you go back to the equation periodically from time to time, but it's pretty much over. We now look at the full information system. Now, when you look at the equation, each one of those, as we said, assets, liabilities, and equity, have the subgroupings which we call accounts. An account is really nothing more than a record that will maintain changes, increases, decreases, and balances in a particular asset, liability, or equity. So an account is nothing more than a device or recording device that we're going to use to capture changes, increases, decreases in the account, and the balance. Now, most companies will have multiple accounts. There are multiple asset, liability, and equity accounts. So they list those in what is known as a chart of accounts. The chart of accounts will list their accounts by number. They will also have them by different groupings. Now, again, looking at some of the applications I mentioned before, in an application for a systems analyst, you have to think about how the company's chart of accounts are structured. when you have a digital transaction, that transaction, of course, is recorded electronically. The computer needs to know where to record the cash received, where to record the land that you purchased, and that's all based on the chart of accounts. Now, the chart of accounts would look something like this, where you would have a listing of the accounts. So cash, again, would be 101. And as the next slide tells you, you will have gaps in the accounts in case, for example, you've got accounts receivable as 111. The next thing you jump to a notes receivable, which is here, which is 121. You leave a gap in there just in case something happens, like, maybe you get a receivable from an employee or a different type of receivable that you want to bring in. Notice also that it's grouped by balance sheet category. So you've got your equity accounts, and of course, in the equity, common stock, retained earnings, and dividends. Dividends, again, do not fall in the expense category. And then, of course, the equity accounts also include, if you think about stockholders' equity, the change in your wealth is also, the change in your equity is also driven by revenues and expenses. So again, this is going to be the basis for today's discussion, because when we start recording transactions, we're going to be recording them in accounts, and we're going to have to make references. So if you have a large system and I'm looking for a transaction, and that transaction gets broken up somehow, I need to find it. And I need to know if I want to go to cash, I need to go to account number 101. So with that said, let's go. We're not going to do any questions here. Let's go to the second learning objective. And we might as well do this now. Better than waiting. Might as well kill the weekend with debits and credits. So here we go. The dreaded debits and credits and the double entry accounting. Now we're going to get into the rules, the actual nuts and bolts, the real life kind of accounting issues that you get involved with when you record transactions. When we look at the transactions, we're going to have two impacts. And where, as you know, two or more impacts, but typically two. So as you know, when we look at this double entry system, and you could have a double entry system that, if you remember, when we paid those salaries and rent in the last example, you paid cash of $3,200, but you also had two other accounts. So you could have more than two accounts. You could have a compound entry. You don't necessarily have to have only two accounts. Double entry simply means that the equation will always be in balance. Whatever you do on one side will have to be an equal effect on the other. And the question you had about equal and opposite effect before is right here, where you would record the acquisition of land by increasing land and reducing the asset cash. Now again, having these accounts will help, because if you remember, this equation gets kind of out of control with thousands of transactions. So we're going to record everything now in an account. The account is going to be built in the following way. The account will have the title, it will have a left or debit side, and the right will be what we call the credit side. Now, when we start recording, this is something I never say to memorize. I always say try to understand. You're going to have to memorize this. So we're going to start with what are known as T accounts. At the end of this chapter, we'll get involved with more formal-looking accounts. Now, remember, everything is done digitally. Whether it's done, you mentioned Excel, some type of computer software. If you got, any type of computer software you can buy, accounting software would be done digitally. But the accounts would look like this. You'd have an account name. On the left, you'd have the debit side. On the right, you'd have the credit. And because of its shape, you call it a T account. And these are going to become very useful for analytical purposes as we look at various transactions. Now, the terms debit and credit don't mean increase and decrease. It's the biggest problem students seeing this for the first time have. When you debit something, you're not necessarily increasing or decreasing it. You're just adding something to the left side of that T account. When you credit something, it doesn't mean increase or decrease. So debiting means just to include something on the left side of the account, right side of the account, you're crediting. It does not mean increase or decrease. In order to have an increase or decrease, you have to know the rules of debit and credit. So again, you must be sure that you understand the rules of debit and credit. So let me summarize this on the next slide. So here's the summary. So again, you'll have a debit side, a credit side. Debit means left, credit means right. And again, when you debit an account, it doesn't mean to increase. To credit, it doesn't mean to decrease. It depends on the type of an account. Now, when you're building the equation, you've got to worry about not only whether the account balances, but now you have to worry if debits equal credits. So you're adding something else to this notion of double entry. So debits have to equal credits as well. And of course, the ending balance, of course, would be either a debit or a credit balance. Now, if you look at, just take any account, whatever account this may be, if you enter a transaction, let's say this is transaction 1 on the debit side, and you enter transaction 2 on the credit side, the larger side, again, we would say that this has a debit balance. So when we think about whether or not an account has a debit or a credit balance, you would have to look at the side that has the largest amount. And we'll now accumulate transactions in these accounts, and those totals would be, in fact, your totals on your financial statements. Yep, debit minus, that's right. So the debits and credits offset. And yeah, the largest side is going to be the balance. Yeah, okay, let's put another transaction right now that has a debit balance. Let's do another one. So let's say that you have another account and you start off with 5,000 in here, but then you have another transaction that credits this transaction. I'm sorry, I didn't put the debit and credit there, but that's the debit, that's the credit. And the balance here is going to be 3,000, and that's a credit balance. So the question was, if you didn't hear the question, is do we subtract them? Yes, you subtract the debit and the credit side, and that in fact would be the balance. But then again, whether this means the account is increasing or decreasing, you'd have to know those rules of debit and credit. So let's go right to the rules right now. And I want to build a slide, or at least look at this from the standpoint of the accounting equation. And these are the rules. And they're going to get a little bit more sophisticated when we bring in the components of equity. Now, don't forget, there are lots of components of equity in there. The components of equity are contributed capital, revenue gains, expenses or losses, and dividends. So equity's got more than just one account. And of course, there are multiple asset accounts. There's cash, there's receivables, there's buildings, land. Liabilities have what? Accounts payable, notes payable. So let's look at the rules. And again, you'll notice that they're going to be equal but opposite effects. So if we start here, assets will increase by debits and decrease by credits. You got to memorize this. You know, I can guarantee you have to memorize it. So asset accounts will increase by a debit, decrease by a credit. So when we had the land that we purchased, instead of saying we increased land by 20,000, we're now going to debit land for 20. Liabilities are just the opposite. Liabilities increase by credits and decrease by debits. So that when you bought the office supplies for 500 on account, we're going to go through this, when you bought the office supplies for 500 on account, that liability, accounts payable, increased by the credit. So now instead of saying we're going to increase accounts payable, we're going to credit accounts payable. And then equity, the same thing. So if you look here for the stockholders' equity, you'd have equity increasing by credits and decreasing by debits. Notice that the claims, liability claims and equity claims, change the same way. Equity goes up by a credit, goes down by a debit. So if you had a sale of stock, the investment of $30,000, that increased by a credit of 30. And again, they are opposite from the effects going into the asset side.
The subcategories in equity, are they all follow that?
Well, okay, that's a real good question. So the question is, does the subcategories in the equity follow the same rules? And it's going to depend. Expenses and dividends would have an opposite effect, which I'll explain. So those are, again, things you have to memorize. All right, so now, as I said, for Smart Touch Learning, when they bought the land, they would debit the land account and credit the cash account. So basically what happened is, just translating this now, if you took, again, assets, liabilities plus equity, you had cash, and then land. And in our transaction, what do? We up until a few minutes ago, we would increase land and reduce cash, just like that. Now, it's going to be different. Now we're going to debit the land for 20 and credit the cash for 20. So the cash decrease is a credit to that account, and the land increase is a debit to that account. And when you first start looking at this, to me, the best way to do it is to go from the equation to the T accounts. Just make that step, and that will help. So again, you would have to, now the entry would be to debit land and credit cash. Any questions on, there's not much this was made up in 1494, I guess. No. Yeah, okay, good point. Question is, do you have to put a plus or a minus in the T accounts? No. Because it's known that if you debit land, it's an asset account, and assets increase by debits. And it's also known that if you put a credit in a land account, assets decrease by credits. Yeah. Yep.
Would that be a credit, and then the debit would be a cash?
Yeah, okay, so his question, all right, good question. We'll get to that, but his question was, how would you handle the collection of a receivable? And you collect a receivable, cash goes up, debit the cash account, and the receivable goes down, you credit the receivable. Right, exactly. Yes?
How are you crediting something that's a negative?
Because cash goes down by a credit. So we're just taking, it's very similar to the question I had before, we're just taking the plus and minus sign and sort of changing the language. So we're saying that when you have minus to an asset account, you credit that account. Again, something you have to, memorize. Now, I'm going to spend a minute, I'm going to keep going over this a lot. The next one, and getting back to the question I had a few minutes ago about the equity accounts. Look at the first equity account up there. First equity account is common stock. And we said equity increases by credits, decreases by debits. So that's fine. So now you have your common stock account. That's going to go up. When you sell common stock, you got a credit balance. If something happens, you would debit that account. Here's the strange one. That's what I wanted to get to. The question was, what about dividends? If dividends reduce equity, then to increase a dividend, you debit it. This is the confusing part. You've got to go over this as many times as you possibly can. So when you increase a dividend, it's reducing equity. And I'll show you the same thing here. I'm going to show you something else in a second. But let me go to the next one. If you think about retained earnings is an equity account. It increases by a credit balance, reduces by a debit. Now, the easiest way to think about and I'm going to show you a slide on this in a minute. I'm going to put something on the dot cam. But if you look at revenues and expenses, when you have revenue, your wealth increases. So if revenues increase wealth, how should you increase revenues? By credit. If expenses reduce wealth, reduce retained earnings, reduce equity, how should you increase an expense? You do that by a debit. So you just have to make sure you understand how these accounts operate, so that when you think about the revenues, expenses, and dividends. So when you look at retained earnings is an equity account. Now you don't have to put these pluses and minuses here, but this may help. Let's take revenues, for example. You should know by now that revenues do what? Increase wealth. They increase retained earnings. So if I have a revenue, I credit revenue to increase it because it increases retained earnings. So if you just think of this, doesn't exist, but you think of this giant retained earnings account where you sort of stick in the revenues, that's the way you can understand this best. That revenues go up by credits and they increase retained earnings. Expenses. Expenses reduce retained earnings, so we increase expenses by a debit that's going to reduce retained earnings. So every time you add to an expense, you reduce retained earnings. That's the way to think about it. Every time you add to an expense, you reduce the retained earnings. And the same thing happens with dividends. Every time you increase a dividend, you reduce retained earnings. So this picture, or if you look at this, copy this down, because to me, that's the way I understand it the best. I take a giant retained earnings account, I sort of slip these other sub-accounts in there, and although this giant retained earnings account does not exist, it is something that you can use to help you through the revenue and expense line items. So again, I could ask if you have questions, but there's really nothing I can say except that you got to memorize this, but I could try to explain it to you differently. Yes?
I thought debit is like what you have and credit is what you owe.
No. Okay. Another important point is a debit something you have and a credit is something you owe. It really depends. I mean, some people that work in banks, it's just the opposite. So, yeah, no, but that's not the way it works. These are pretty much rules that are created by, it's a system that we have to use. By the way, does anyone know what time it is? Hold on. Yo. I've got 2:14. All right? So I don't know. That clock is wrong. So I didn't start with that one. So it's 2:14. So another 6 minutes. Let me answer this question. The word credit does not mean you owe something. The word credit, in fact, here is just a way to increase revenues. That's the way you have to think of it. So let me just show you okay, good.
No, I was just going to say, like, with the first example, with the 10,000 and 9,000, if you put 1,000 in credit, the balance in the debit is 9,000. So isn't that like something that you stop and see?
Yeah, it could be an asset. It could be an asset. It could also be, question is a debit balance always an asset? It could be, but what if you have an overdraft on your, or you have a liability that you pay too much on? What if you owed me 1,000 but pay me 3,000, right? So now you have a debit balance and a liability. So I owe you that money back. So yeah, it's kind of like that, but we have to watch. You have to be careful in drawing those conclusions. All right, so now here are the rules, and this is your. Unfortunately, you got to kind of print this thing out and kind of stare at it a lot. If it makes you feel better, make it your screensaver on your cell phone so that, when you're walking around, just dodging, not barely getting hit by cars, All right, so make sure you memorize this. And here's the most important thing here. You got the normal balance. Now, accounts have normal balance. As abnormal as this whole subject seems, there is some normality to it. And the balance that you would expect an asset to always have is a debit. And that's kind of the question you were asking me before. So assets increased by debits, reduced by credits. The normal balance is a debit. Now, that's a normal you expected. It doesn't have to have that balance. For example, if you have a bank account, checking account, and you overdraw the checking account, you could have a credit in there like a liability. So normally this is what you're going to find. So you've got to memorize this. And another way to do this, let me just make sure you'll see what I want you to do. You got to memorize. There's another way to do it. There's the rules in the expanded accounting equation. And finally, you've got another way to look at this through the giant stockholders' equity